This is one that we've run before, entitled Paying for Care, which is a bit of a mad session to try and do in 45 minutes and allow time for questions. So it's a little bit of a whistle-stop tour. But the main aim today is to sort of get people aware of some of the key issues, the key funding issues for those who are caring or assisting others in their care need. So if there's anything that you want to really discuss in detail or doesn't make sense, don't forget you can just ring the helpline and chat it through with the team. But what I'm going to do today is just split this into three main sections, if I may. The first one will be sort of benefits and general assistance. So that's really intended to target people who are receiving their care at home. Then I want to move through into state, local authority and NHS support for those who have a more acute need for care at home or in a care environment, in a care home environment. And the final section I want to look at is those who are in the wonderful position of self-funding their care and all the issues that brings. So a lot to cover, and I'm conscious that we're a little bit behind, but let's sort of press on. So in terms of benefits, in terms of the help that you can get from the state, without doubt, in my view, the most important benefit to be aware of is attendance allowance. Apologies if you already know all about it, you're already claiming it, but I'm astonished still at the number of people on the helpline who either misunderstand and don't quite realise what's involved. So I'll quickly take you through it. Two big misconceptions, if I may deal with that. The first is that you do not need to be attended in order to qualify. A lot of people think I've got nobody visiting me, therefore it's not a benefit I can claim. That's not true. You merely have to demonstrate the need to be attended. And the second thing is that it's not means tested. I tell the story regularly of a conversation with a GP who was adamant his mother wasn't entitled to attendance allowance because she had too much money. So not true. No means testing in terms of capital or income. And in terms of what it's used for, again, the misconception is it must be an absolute, paying a carer. Again, not the case. You could use it to pay for taxis. You could use it to pay for shopping deliveries. You could use it to pay a cleaner. It's there to help you deal with day-to-day or issues of day-to-day living. So, two benefit levels. The first one, lower level, is worth £73.90 now. And that's for people who need, the definition is frequent help or constant supervision during the day. Now, that could be anything. To give you some examples that are not so obvious, I'm aware of a gentleman who receives attendance allowance because he has somebody who comes in to read his post to him because he's severely handicapped in terms of sight. So that would be a qualification for attendance allowance, just as an example. The higher rate, which is £110.40, is available for people who, in addition, need help and supervision during the day and night. So for most people, we can be safely tucked in bed and be fine until the next day. But for those for whom that is not the case, then the higher rate would apply. So as a general, very much a general rule of thumb, you tend to find people who are being cared for at home tend to qualify for the lower rate, and those who move into residential and nursing home would qualify for the higher rate. But that's by no means an exclusive description. There are lots of people who fall in the middle. If you want to find some more information out, the best fact sheet on attendance allowance is provided by Age UK. It really is excellent. It's about 12 pages and there's lots of caveats, but it does explain everything. You can apply for the benefit online. The form is not particularly user-friendly, like most of these things, but it's fairly straightforward. And the key section is really the bit that asks about medication. It's so much easier if you can insert the details of the tablets and medications that you're on from the GP, because that helps to tell the attendance allowance unit what your conditions are. And Two exemptions, just to be aware of. One, you can't receive it if you're in hospital, because the argument is the state is already looking after you in your hospital environment. The second one is that you can't receive it if your care is being funded by the local authority for exactly the same reason. But if you are self-funding your care in a residential home, then you would be able to qualify. So it's a key and vital benefit. In real terms, it's a gateway benefit as well. It's the premise and the basis upon which lots of other benefits flow. So missing out on it can have quite considerable knock-on effects. So I would encourage everybody to just have a look, even if you think you don't qualify, and remembering that you can use it for all sorts of things just to help and support your day-to-day living. So moving on, the next most relevant, I would say, benefit, and one that directly links from attendance allowance, is carers allowance. Again, does suffer some degree of misunderstanding. It's worth £83, £83.30 a week, I think is the figure. To qualify, you should be caring for somebody for at least 35 hours a week who should be in receipt of a relevant benefit. Attendance allowance be the obvious one. PIP would also count. Now, some people think 35 hours a week, oh, that's far too long. I'm not providing care in anything like that length of time. But again, you've got to remember what it includes. It includes everything: shopping, cleaning, cooking, washing, taking you on an appointment, any managing the bills. I suspect if we all sit down, we'll find that we are rather closer to 35 hours than we might initially think. You don't have to be living with the person. You don't have to be related to them. This could be something that you do for the neighbour across the road. Now, where it gets a little bit complicated is that there is an earnings limit. You can only qualify for carers allowance if your earnings are below a certain figure, and you cannot claim it if you are in receipt of state pension. So that's a big cut-off point. But this issue of how much you are earning has been the reason lots of people haven't made the application. They're either earning too much and don't qualify. But the allowance was increased last year by, I think, 25%. It's gone up to £196 a week after tax, national insurance, and legitimate expenses. Now, I don't know if anybody else is familiar with this, but we've found a really important issue around this. And it basically relates to people, usually ladies, I have to say, who are in the age group 55 to 67. In other words, they are over the minimum age at which you can start receiving your private pension, 55, but you're below state retirement age and you're not therefore receiving your state pension. A lot of those people are still working, but finding it increasingly difficult to look after mum, dad, and do all the things that we've said. But they can't afford to give up their work because the replacement of carers allowance at 100, the earnings for less than 196 just isn't enough. £83 isn't going to get you too far. But the thing to bear in mind is that within that calculation, any private pension that you're receiving does not count towards that limit. So what we've seen over the last year or so is an increasing number of people in that age group who are reducing their working hours to less than £196 a week, which allows them to claim attendance allowance. Sorry, allows them to claim carers allowance because mum and dad are claiming attendance allowance. And they then begin to draw down their private pension to top up their income to the level they need, because that doesn't count towards the cutoff point. Hope that makes sense. So what we're finding is it's working as a really good transition mechanism to allow people to move from full-time work to caring progressively for their parents or their neighbours or their aunt or their uncle. And quite often they can step down their earnings and working hours in order to provide the increase in care need and just top it up with extra payments from their pension. And we don't find that's explained terribly well in many places. So if that's something that might work for you or might make sense, as I said, by all means, give us a ring and let's work it through. You do have to go and consult with your financial advisor to see what you can take in terms of drawing down from your pension. And obviously you have to consult with your employer about your working hours, but there is a balance to be struck there, which can work quite nicely. Third benefit that I would mention is pension credit. This really is the replacement for the old income support system. It isn't simple. It has no fixed value, but basically it's there for anybody over the state pension age on a lower income. And I would encourage you to just go and check whether or not you qualify. There are a whole host of pension credit checking systems online. The government has one. I think Age UK have quite a good one. And you can punch in the numbers relatively straightforwardly and just see if you would qualify. Worth checking. And I mention it particularly because, of course, last year, the winter fuel allowance was dependent on pension credit. And one of the criticisms that was made of the government was that, I think the figure is that there's 700,000 people in the UK, it's astonishing the number, who would qualify for pension credit who don't claim it. And the only reason they don't claim it is because the system doesn't encourage you to do so, and it's a bit complicated. So there's lots of people out there who would benefit from just having a look and seeing what might be available. And the only other section I wanted to just cover here is what I just term other benefits and help. They're not allowances as such, but these range from things like council tax exemption for those people who have a dementia diagnosis. So that's 25% if one person in a couple has a severe mental impairment, and that is definitely something worth claiming. Another one is the blind allowance. Anybody who has sight impairment is likely to qualify for this. It's odd really, because it's an additional tax allowance from HMRC, £3,070. So you can earn an extra £3,000 and not pay tax. If you qualify, you just have to get a medical certificate from your doctor or from your optician. Blue badge. How we would all love a blue badge, which means we could then park in all those places that we're not allowed to. But if you're trying to get mum and dad to the hospital appointment or, well, anywhere these days, that blue badge can be crucial. So again, just go and find out and check. I should really mention CAB. You know, that they're a great place to go to and just present your situation to them and say, can you just make sure that I or mum or dad, whoever it is, or all of us, are actually getting the help and the benefits that we're entitled to. And they can run you through all the options. And as I say, remember, attendance allowance is crucial because it's a gateway allowance that opens the door to lots and lots of others. So vital. I do meet some people who won't claim on principle. I've never claimed anything off the state. I'm not going to start now. But I would argue that having paid in £110 a week to help you when you need it is something you really have to have a look at if you qualify. Okay, so the whole point of all of that is that should provide extra money in one form or another, either to you, the individual who has issues, or to the person who is helping you to deal with those issues. So this is going to apply to all those people who are still at home, broadly living independently, but need a bit of assistance. And that can make a huge difference to extending the length of time that you can manage at home because you get help earlier. And we are constantly trying to press this point about early intervention. The sooner you get extra help, the longer you will stay at home independently. I meet so many people who have started the process too late out of either ignorance or independence or all those things. And I very rarely find it helps. So we're constantly encouraging people to just go have a look, see what you can get to help. So if we move through the process now, we start to think about what happens if your care need, support need becomes a little bit more than just help with the shopping and all the things we've talked about. Then unfortunately, we have to understand that this is a monetary-based system. We should, this very week, in fact, have been welcoming the new care funding system that was put in place as part of the Care Act in 2000 and, can't remember, years ago. Should have begun this week. Being delayed, being deferred, being eventually discounted. But that would have brought in the care cap and all those other things that, whilst not perfect, would certainly have helped. So the problem is we're now back with the old state system that we had. We've got the government instigating this commission, but to be honest, the reporting timescales are outrageous, way off into the distance, and that's only for the report to be commissioned and reported back on. How long it will take them to put in place any action as a result of that, who knows? So we have to deal with and understand our current system. And as I say, money is the arbiter as far as that's concerned. And the key number is the £23,250. If you have capital above that figure, assessable capital above that figure, then you will basically not get any help from the state. I'm going to come on to those who are in that position shortly, who are self-funding. But just let me explain what that consists of. Because for most people, the key issue is the house. So let's deal with, when does the house form part of the equation? Well, let's deal with the issues where it doesn't. The local authority are automatically obliged to disregard and exclude the value of the house if you're still living in it and receiving your care at home. So if you progress from the point of just needing a bit of help and support, but you now perhaps need, I don't know, a carer to come in 3 times a week, once a day, whatever it might be, and you're looking for funding support, then if you have less than 23,250 in savings, then you would get help from the council because your house would not be included. How could it be? You're still living in it. You still need that as your place to live. If, however, you've moved into a care home because your need is that bit more acute, then the house, obviously you're not living in it, therefore that exclusion doesn't apply, but it will be excluded if it's occupied by your spouse or your civil partner automatically. We do get lots of calls on the helpline from people who are worried about how they're going to cope when their spouse goes into care. How will they be expected to pay back the money that they owe? And of course, the answer is they won't. There isn't a debt. The house is disregarded. One that often goes overlooked is that it will also be disregarded if it is occupied by somebody over the age of 60. So that could be your brother or your sister who has lived with you, moved into the property, and he's now over 60 at the point that you might need care. The principle is quite simply, we don't want to make people homeless as a result of trying to use your house to pay for care. Just a word of caution, if that person moved into your house 3 weeks before you went into care, the local authority may question the motives of that. In other words, were you doing it purely to achieve the disregard? So I'm talking about general family situations, where that older person lives with you, but isn't your spouse or partner. So those are the 3 automatic disregards. There is a 4th one, which is discretionary. This is where a person lives in your house who is under the age of 60 and he's not your partner, but has been your carer. I'll give you an example that might make it easy. This case was a chap who lived in Amsterdam, and he'd lived there for a while, had a flat, had his job there. His mum had a stroke, and he just felt the right thing to do was sort of pack up and move home to look after her, which he did. 6 months later, she had a second stroke that left her unable to cope, and she had to move into care. So the question was, should their house be disregarded? Her son was 57. He'd been there for only 3 or 4 months. But it was quite clear, the evidence was quite clear as to why he had moved back. He didn't know she was going to have a second stroke and she would have to go into care. So what the local authority did was said, we will disregard the house value for 12 months to allow him time to sort of put his life back together, find alternative accommodation and move out. So it's not necessarily going to be a permanent disregard, but it might be a partial one that would help. So those are the main property exclusions. One that we do get asked about a lot is issues of where the property is owned by somebody else. Most typically, it's been moved into trust, given away to the children. Now, we could spend the whole hour session on that alone. We do have a session later on in the year about deprivation. And I'm not going to spend time on it today because it's just too big a subject. But again, if you're in that situation, a quick word to the helpline would help. So let's work on the basis that you have something in the region of £20,000 just below the threshold. Your house isn't disregarded, or you don't have a house, whatever it might be. Then comes the issue of how will the local authority support you. And the first and foremost thing to bear in mind is they must undertake, first of all, an assessment of need to determine what is your need, what is your situation, and how can that best be delivered. Will that be through 2 visits a day? Will that be through support from the family, a combination of the two? As a general guide, we find that if people need more than 4 visits a day, usually half an hour, if you're lucky, quite often 20 minutes because the person's running behind and has got more appointments and traffic conditions to deal with. But if it's more than that, the likelihood is that the local authority would suggest a move into care. 2 reasons. One, it's probably cheaper. And secondly, it's probably safer for you. Because let's be honest, 4 visits a day for half an hour means that you're on your own for 22 hours a day, which is not likely to be suitable for you. So if we start with the home care cost, let's say you need 2 visits a day, then the local authority have assessed that that's the right thing to do. Your capital is less than 23,250, so you're going to get help, and they will support you. They will work out what you need to pay your gas bill, your electricity bill, all the expenses of living at home. And they will look at whether you could afford to make a modest contribution towards your care cost. It usually is quite modest unless you have a large private pension. And the idea is that the authority would top up your position to meet that extra cost. So if there's £100 a week of carer cost, you might be asked to pay 20, and the local authority will pay the balance. So in other words, you've got to be allowed to continue to maintain your lifestyle and your property in the way that you were before. If we then move on to the need being such that you need to move into a care home, the situation changes slightly because now, of course, you haven't got the expenses of your home. So your contribution towards your care costs will basically be your state pension, any benefits that you're entitled to, and any private pension that you might receive. So if you're receiving, I don't know, £300 a week, let's say, and the care that you need is going to cost £800, then the local authority would be required to pay the extra £500. But a couple of things just to bear in mind. Quite often we find that with a couple, and this particularly applies with the husband historically, husband and wife, the husband tends to have, in the generations that we're talking about, the higher private pension income. May have been out going to work while mum was bringing up the family. If it's dad that needs to go into care and he takes his private pension with him, then quite often that can leave mum unable to cope at home because she's still got the same bills, but she's now not got her husband's income. So there's two things you need to bear in mind. One is that if the husband pays half of his private pension to his wife, and the local authority must disregard that from their assessment. So if he's got £100 a week private pension, then he can choose to pay 50 of that back to his wife, and the local authority must accept that. So it can be really useful to support the person who is still at home. So that's worth bearing in mind. The second thing to think about is that even though you have less than 23,250, this does confuse people, there is a requirement to make a contribution towards your care based on the capital that you have. To put it simply, it's kind of an assessment of the interest that you might earn on that savings. And it applies from 23,250 down to what's termed the lower threshold, which is 14,250. If your capital falls in between those two numbers, then you're required to pay £1 a week for every £250 that you have, which when you say it quickly sounds like nothing at all, but I would just ask you to work it out. The difference between 23,250 and 14,250 is 9,000. So if you had exactly 23,250, you would be expected, because you've got £9,000 above the lower threshold. If you divide that into £250 parcels, there would be 36. So you would be expected to pay £1 a week for every parcel. So £36 a week would be your contribution towards your care costs, simply because you have those savings in the bank or in the building society or whatever it may be. And if you actually work it out, it's an assumed interest rate of 20.5%, which is scandalous. And most people don't notice it, but that's what it actually means. So actually your capital will go down as you're paying this contribution until you reach the £14,250, at which point you're not expected to make any further payment. There's a bit of an offset that does help, which is that of your income, you're allowed to keep what's called the personal expense allowance, which is £30, 65p. That's supposed to be your pocket money, your retained money for paying for toiletries, newspapers, hairdresser, that kind of thing. So for a lot of people, those two things actually balance themselves out. They don't really notice, but you are actually being charged for having savings, which I think is just a bit unfair. But anyway, it is what it is. You just need to understand how the system works. Now, there are some people, relatively few, who may have less than 23,250, but have a huge private pension. They may have one of those wonderful gold-plated pensions from years ago that actually means that they have a greater income of their own than the cost of the care that they need, in which case this requirement for the council to pay the top up, the difference, doesn't exist. So it is possible that you can be disqualified on income as well as capital, but it is a little bit unusual, particularly with care rates in the sort of £800 a week mark. You don't meet too many people who have an £800 a week income, but it can happen. Which kind of brings us on to the other, I guess, contentious issue, is the price that the local authority will assess your care need at is likely to be lower than the fees being charged by the home that you might want to go into. So typically £850 a week would be the local authority's price for an average care need. It will vary according to the individual circumstances. So people with dementia, people with nursing needs, the price will go up. But basic care might typically be in the region of £850 a week. But it's not always easy to find a home that will charge that rate. Why? Because, well, there's two arguments. One says that the local authority do not pay enough as a commercial rate for the care that is needed. And some people argue that the care home charges too much to those people who are privately funded. And that argument has raised the 35 years I've been involved in this work and has never been resolved. My honest opinion is it's a bit of both. If you go to an absolute top drawer care home, that provides string quartets on Sunday and champagne before your lunch, you might expect to pay £2,500 a week. And that is perhaps a little excessive. But down in that middle group, it is difficult to run a care home on local authority rates. And of course, as individuals, we want the very best care for ourselves or for our loved one. And that is usually going to cost more than a 2-star hotel would. If we're all choosing where we're going to stay for our weekend away, some of us might feel a travel lodge is fine, but we might want something a bit better. And what this introduces is the concept that the care home may require an additional payment for the person to live there. And that is called a top-up and usually causes lots of chaos. Why? Because the top-up payment cannot be paid by the individual who's in care. It has to be paid by a third party, which is usually the family, the son or daughter, who may or may not be in a position to make that payment. So what I would say to you is if you are going to be funded by the local authority immediately, then don't go rushing off choosing the home that you would like, because you may find that the prices don't fit. And if you're moving into a home where you're self-funded, it's all very well thinking, yes, I can afford to pay this, but have a look at how long you can pay it for. Because if in 6 months' time your figures, the capitals drop below the 23,250 and you're then claiming support from the local authority, you may have a fairly hefty top-up to pay. I generally find that homes are not clear enough about this. They feel it's a bit of an awkward subject and they don't really want to talk about it. But I would encourage everybody to ask the question when you're looking at homes that might be suitable. Now, for lots of people, as we move through into the issue of being self-funded, you can have a situation where you may have moved into care and be in the process of selling your house. In other words, you're going to have more than 23,250, but you haven't got that right now. And therefore you can't afford to pay for your care fees. In situations like that, the local authority will provide something called a deferred payment agreement, but basically they will lend you the money to pay for your care until your house is sold, and then they will give you, then you will be expected to pay that money back out of the proceeds. They do charge interest, but it's not excessive, and it is set by government, so it's kept reasonable. They can charge you a fee for setting up the arrangement, a bit like an arrangement fee would at the bank, but again, it's not huge and not everybody applies it. But it is a useful way to get some interim support from your council between moving into care and selling your home. But something again to bear in mind, there is something called the 12-week property disregard. And what that means is that the local authority must ignore the value of your property for the first 12 weeks of your permanent move into care. The idea is simple. They don't want to force people into selling their house until a move into care has been definitely decided as the best option. So you're given 12 weeks grace. So if your savings are below 23,250 and you've got a house to sell, it won't be taken into account for 3 months. The local authority will pay your care fees. You won't have to pay it back. And then on week 13, the option is that you've sold it and you can pay yourself, or the deferred payment agreement might become available. So even through this kind of period of being supported by the local authority, it is extremely complex. We've just touched really just on the very superficial points. And I apologise if that's caused any confusion. It is hugely complex, but that's the basic principles that apply. Now, I should just mention two other state support elements. We get lots of people who have read or heard about something called continuing healthcare, which is basically the support provided not by the local authority, but by the NHS. This is touted, in my view, too readily as being available for people with general care needs. That's not what it's designed for. It's designed for those people who have an acute care need, who need significant nursing intervention in their care. So if you think of the difference between social care, which is basically just help to live, it's not a medical intervention, it's not a nurse, it's just you need help getting up, bathing, washing, eating, all those normal things. That doesn't fall within the remit of the NHS anymore. It used to do when we had geriatric hospitals, but it doesn't now. So I find lots of people who think, oh, we're going to be fine because mum's in a terrible condition and we're going to apply for continuing healthcare. It is extremely hard to get. And based on the latest data that's come out, fewer people are getting it because the qualifying conditions are getting tighter. So I would generally encourage people not to go in with high hopes of getting it. I think the figures I saw last were that 17% of applicants were successful. So it's not many. And your care home will very quickly tell you whether you're likely to get some help. But there is a help available one step down. So everybody who moves into a nursing home or a residential care home with nursing, to give it its technically correct title, then you will automatically qualify for something called FNC, which is funded nursing care, free nursing care, some people call it. And the idea is that this is a fixed sum of money to allow the care home to employ registered nurses to carry out a little bit of the care that that person might need each week. So in other words, the conditions are more acute, nursing care is needed. That's likely to involve a nurse giving some medication or injections or whatever it might be. And the NHS will pay a quite significant £254.06 a week directly to the care home. But anybody, it doesn't matter whether your nursing need is 1 minute a week or 10 hours a week, you get the same amount. But it does cause confusion, and I'll explain why. The payment is made by the NHS directly to the nursing home. So when you're looking at home and you're asking what the fees are, and they say it's £850, you have to make sure if it's a nursing home, does that include or exclude the funded nursing care? So in other words, is that paid in addition or is that towards the fee? And it does cause a surprising amount of confusion. And I mention it so that if it applies to you, just check it out and make sure that we're all clear about what the fee includes. So I personally would like to see price for the care home plus funded nursing care, and then everybody knows where they stand. Because as I say, it's paid to them directly. So moving to our third group, which is those people who have either not qualified for all the things we've said up to now, or have now sold their house, moved into a care home, and they are now self-funding. I guess in some respects, it's probably the easiest group to deal with. The hardest is that where you've got a period of funding on your own, and then you become dependent on the state. So let's just talk through what might happen for those people who are self-funding. The key thing for me is to work out what the shortfall is. In other words, what's the difference between the person's income and their person's care costs plus expenses? Now, for most people in a care home, expenses reduce dramatically. It might be, I don't know, £1,000 a year for general items that they might need, or a small amount of money for gifts at Christmas, that type of thing. So you've got the basic care cost. So if we take a figure of, I'll take £1,000 a week because it just keeps my maths easy. And let's say they have an income from their state pension, their private pension, and their attendance allowance of, let's say, £400 a week. That would seem reasonable. So their shortfall, that person's shortfall, is that they are £600 a week short of being able to pay their way, which is £30,000 a year. As a typical, and I see lots of people who have bigger shortfalls than that because they're in more expensive homes, and people with smaller shortfalls because they've got bigger pensions. But if we took the average person across the UK, and I guess that would be fairly accurate for Gloucestershire, I would say people have around £300,000 worth of savings, which is the proceeds from their house. If you took an average house price, probably a bit knocked off because older people's houses tend to maybe need a bit more work and a bit of updating and that type of thing, and some capital and savings that they've accumulated. So I think 300,000 would be about the mark. So clearly what we need to do is just find a bank account that pays a 10% interest. We can put the £300,000 in the bank, draw out the interest, and that would solve the problem with the care fees. But of course, that's not the situation that we've got. And therefore, what we see is that capital position declining year on year on year. So for most people, if you live long enough, you'll run out of money. You'll reach the 23,250 mark and be knocking on the door of the local authority, which in itself is not ideal. But of course, the other thing is the family's inheritance has disappeared during that period. So what can you consider doing about it? The area I would just touch on today is something called a care annuity. Basically, what you're saying to the world is, my fear is that mum or dad are going to live a long time. And I hear people say, well, Uncle Charlie lived to 97 and so did his dad. And, there's a general trend for the male generation or the female generation in a family to live long and well. And they sort of look at those numbers and think the money's going to disappear fairly quickly. So what you can do is you can go to there's a group of specialist insurance companies, not many of them, and you can say to them, will you take over mum's shortfall for the rest of her life for a fixed amount of money that I'll pay you today? And there are some that will do that. So they take a really difficult view, not one that we can all easily take for our family, but they will make an assessment of what they think the person's life expectancy is, and they'll base that. There's no medical, there's nobody going sort of poking mum and dad and checking them. They'll do this through the doctor's report, GP, through the care homes report, and they will look at the medication and the medical history, and they'll basically make a guess. And I know they try and make it scientific, but it is just a guess. And let's say they took that example and said, we think you're going to live for 3 years. And you want us to pay £30,000 a year for 3 years. So that's £90,000. We need to make a profit. We need to cover our costs. We'll charge you £105,000. Well, as a family, you could look at that situation and say, right, we've got £300,000 on the table. We can pursue our own route and things will be as they will be. Interest rates might go up, they might go down, one might live longer, shorter, and you will get whatever's left. Or we can pay the £105,000 to the insurance company, knowing that will cap the cost, whether she lives for 1 year or 20 years. And that has the benefit of then ring fencing the inheritance from the family point of view. So as you can imagine, if mum died after 12 months, the insurance company will have had 105,000 and paid out 30. And if she lives to be 110, then they'll have had a very different experience. I always make the point, I don't like insurance companies because the very basis of them is that they have to take more money off us than they give us back. Otherwise, they wouldn't be there. So you have to go into these things kind of knowing that you will probably lose financially on the law of averages. But what you bought is peace of mind. You bought some degree of protection. And of course, if you go back to my point earlier about homes charging more than the local authority rate, it could be quite important if you've chosen a home at, for my example, £1,000, but let's say it was 250, then the care annuity can help you secure funding in the home of your choice, perhaps at a better or higher level or a more suitable level. So they can be useful. They're not for everybody. In my experience, I would say between 25 and 30% of people take that option. But what I do find is lots of people go and get a figure, because what you're actually getting is an independent assessment of your loved one's life expectancy. Because how can we possibly give a view? We're too close. This is just somebody who's never met them, who doesn't know them, who's just looking at it from a numbers point of view. And even if you don't pursue that option, it might just give you a little bit of a baseline or a benchmark to think, okay, they've said, they think, they don't actually say this in their quote, you've got to work it out. But if you take the amount of money you're giving them and divide it by the annual benefit, you can very quickly work out with an allowance for their costs and expenses what they think the person's life expectancy is. So it can help you in deciding not to pursue that option and maybe to look at the other choices that are available. But I would encourage everybody, you have to get specialist advice on these things. I'm pleased to say that the insurance companies will not deal with the public directly. And in my view, quite rightly, you have to go through a specialist who can help you understand how the state system will work, and how the whole thing will fit together. If you need that, then you will be able to find a member of the Society of Later Life Advisors. Just go on their website, type in your postcode, and up will pop a list of people who are qualified in this area, and it comes up in order of how far away they are from you. So good to get advice and just find out what might be useful. Okay, I've got not even 5 minutes, just a couple of minutes. I've put this item at the end because it doesn't really fit into any particular category. But if you take the broader basis of our session today, which is financial considerations for those people with a care need or looking after somebody with one, I just wanted to raise the issue of wills. Now, not everybody has the capacity to change their will. So this is really something to look at as early as possible. But I find three things about wills that cause a problem. The first one is that people specify their bequests to the grandchildren typically in monetary amounts. For example, I want to leave £5,000 to each of my 5 grandchildren and the rest to my son. Now, that's fine when you're sat in a £300,000 house and you've got some savings. But if you've been through the care process, then the £5,000 for each grandchild is more than the 23,250 you would be allowed to keep under the care system, which means basically your son would get nothing. So I would always encourage people to change their will to percentages so that way, regardless of the amount you've got, the distribution remains valid. Otherwise, you've got to keep running back to your solicitor and paying him to change your will. So really encourage you to think about percentages, not amounts. And the other thing I would encourage everybody to do is to disinherit their partners and spouses, which sounds dramatic, but I see a constant situation where people have mirror wills. In other words, mum leaves everything to dad, dad leaves everything to the mum, and thereafter to the children, which is fine and totally understandable. The trouble is, it creates what I would term a concentration of wealth. So imagine husband and wife have left everything to each other. Mum goes into care, the house is disregarded because dad's still living there, and then suddenly he has a heart attack or a stroke and dies. Mum not only gets her half of the house because it's now no longer disregarded, but she then inherits dad's half as well. So a concentration of wealth in the survivor, which just means they've got more money to pay towards their care that the state can expect them to use. So what I quite often would encourage is that you leave your respective share of your house either to the children or to a trust. Again, that's a subject we could spend a full session on. You have to do two things to achieve it. One is you obviously have to change your will, but secondly, you have to know how your house is owned. For most people, it's owned jointly. Any asset that's owned jointly, on your death, will automatically pass to the other owner. Think of it. Think of a bank account. If you have £10,000 in a bank account and you die, your share will automatically pass to the other owner, regardless of what your will says. Exactly the same thing applies to property. So if you own your property jointly, you have to change that to something called tenants in common. Sounds very complicated. The technical term is you sever the tenancy. Sounds brutal, but it's actually a one-page document that allows that to happen. And that kind of leads me to my final point, which is I encourage older people not to have too much money in joint accounts for the reasons I've just given. In the event of death, that money automatically goes to the other person. But I also see couples with joint accounts where one of them has a degree of care need, whether that's at home or in a care home. You need to separate funds so that the person with the care need is paying for their fees, because that way they'll get to the point of getting state support sooner. If dad's paying half of the bills or out of the joint account, then he's effectively subsidizing the state. So I would generally encourage that you have smaller amounts in joint accounts, and preferably just have two separate accounts and then pay a little bit each into the joint account to deal with the household bills.